Welcome to Pioneering Pensions. For you who don't know me, my name is Stefan Lundberg and I have a passion for pensions. Today, we're going to deep dive into the challenges of actually building a life cycle investment strategy. As Yogi Berra said, in theory, there is no difference between theory and practice, but in practice there is. So today, Catherine Reilly is joining us and she's going to walk us through her thinking, her thoughts around building life cycle for many pension schemes over the years. She has a background from State Street and also worked for Smart in the US. And another thing you might not know, she's from the Nordics too. So with that, Catherine, welcome to Pioneering Pensions.
Hi, Stefan. Thank you so much for having me. I have to confess, I also have a passion for pensions, so we can form the official pension passion party, I suppose. And yes, you might not think it from my name, but I have a strong background in the Nordics. So my mother is Finnish, and I've actually lived in Finland for a long time. So thank you very much for inviting me to join you.
My first question to you is, we had a lot of guests talking about life cycle theory on how to do that from the theoretical perspective. And, theory gave us a good steer on what's going to happen. We know that when you're young, you can take a lot of risk. And when you're sort of older, you should de-risk a bit. We also know from previous episodes that equity risk premium, over time, it's sort of decline. It's not that it's theoretically there, but it's empirically observed. So when you are thinking about building a life cycle, I think for the saving phase, we all sort of agree that, yes, you should take a lot of investment risk. But when you're getting close to retirement, you have to start thinking how I'm going to do that. So when you apply these theories and this empirical observation to build investment portfolios, how does it work? What sort of are your takeaway?
Like you said, in life cycle investing or in target date investing, which is what you commonly use in the US, which is basically a life cycle portfolio folded into one fund. That's exactly how it works. Usually you start off with a higher allocation to equities, and then that gradually de-risks over time, and you have a landing portfolio in retirement that is more conservative. So, I mean, that's basically what all the portfolios look like. One of the big challenges is when to start to de-risk. A lot of target date funds in the US, for example, already start to de-risk, albeit very gradually, at about age 40, which seems very early to me, but that's kind of where the industry has converged. And then they de-risk to a stable portfolio after retirement. And I think the general profile makes a lot of sense, but it would be nice to be able to play around with this a little bit. And the thing is also, you have to balance different perspectives. So you have theoretical perspectives like, you could use a utility function, and we can talk a little bit about this more. But in practice, you usually end up using a more pragmatic approach of what is likely to deliver robust outcomes at different points. And then you have the theoretical approach of what delivers optimal investment outcomes. And then you have the behavioral approach of what is likely to deliver optimal behavioral outcomes from participants. So although it might make sense to have 100% in equities right at the start of the savings period, I know that some providers, for example, Nest in the UK, have opted to use a lower equity allocation because they don't want to scare people. So you're balancing a lot of different theories and considerations to finally land up with something that is robust, that is palatable to the investor, and that also consistently delivers good results.
I mean, we all learn in school that you should use a utility function, and based on some sort of risk appetite, when you have that, you can actually get to your optimal portfolio. And Arun, in a previous episode, he said, well, how does anyone do that? So they just do traditional mean variance. But what do you do instead? If you don't have the utility function, what are you looking for when you're putting it together?
I mean, I think you're looking for something that is robust. I mean, the big challenge with utility functions is, or I think it's a challenge with any models. I mean, the first rule of using models is that the model can only tell you what you have already told it. So, I mean, in that sense, they're very useful because they make the impact of your assumptions very explicit. And the second rule of modeling is garbage in, garbage out. So even with mean variance, you have an elegant theoretical outline. You know, you have to know what the mean is and what the variance is, and it will tell you what the efficient frontier is. The big problem is you don't know what the mean is and the variance is. You have to forecast them. But at least for those, you have observable historical data that you can use as a baseline. With utility functions, like you said, there is this very important parameter of risk aversion. And I think risk aversion is one of the most difficult things to observe. You know, there are all these questionnaires, but I very much doubt that people understand what they are answering when they respond to those. And there are different types of risks. So there is the risk of, do you want your balance to fluctuate now? But you have to weigh that against the risk that if you're too conservative now, then you risk shortfall risk later on because you're not getting sufficient returns. So in the utility function, you have this risk aversion parameter, which basically there is no observable information for. You have to assign a value to that, but the value that you assign to it, which is totally arbitrary, has a huge impact on the shape of the function. So basically, by tweaking the risk aversion parameter from 2.3 to 2.7, and there is no solid justification for which of those you could use, you can basically make it look however you like. So in practice, what you end up doing is utilizing mean variance optimization and also creating a glide path using a lot of Monte Carlo simulations that gives you reliable outcomes in the vast majority of scenarios.
Yeah, with this, I say risk aversion, I blogged about that at some point, but I have such a difficulty defining. If you ask me what is my risk aversion, I couldn't define it, and it's also changing over time and with my temper. So this is something that is really, really difficult to pin down. I fully agree with you. I was wondering, you're also talking about sort of the behavioral aspects, so the non-financial factors that drives life cycle design. Can you tell us a bit more how you sort of apply that in your practice?
I mean, a lot of it is thinking about how people, because real people are going to be using these things and real people are going to be reacting to these things. So obviously we don't want to have, when some people, early in their retirement savings journey, people tend to be very passive. You know, particularly if they've been opted into a solution and they don't really pay much attention to what's happening to the value of their savings. But you do see a clear uptick in attention as people approach retirement. You know, particularly 10 years before retirement, you see that people are starting to sort of save more and they're presumably looking more at their investments and everything. But I think that the behavioral aspect of things, it's probably not so much what is in the investments. It's more how you communicate those investments. And I think that's something where we as an industry need to do a lot more work on the participant or member in the UK engagement part of things, explaining to people what's happening with their balance, showing it in a way that makes sense to them, and also allows them to make, you know, if the default that is being presented to them is not appropriate, that makes it easy for them to then make different choices. So one approach I really like, which I know that Don Ezra has also promoted, is that for people close to or in retirement, you split your money into two buckets. So you have one bucket that is invested very conservatively in short-term bonds that will have minimal fluctuations. And that's your spending money for the next, 1 to 5 years. We can debate exactly what is the right period. And then the rest of your money is invested for growth in 100% equities, or at least a very high equity allocation. And it seems this is an approach that I've been working on a lot recently. And it seems to me the hope is that by giving people the security that their immediate needs are catered for, that will take the focus off what is happening on the stock market and reduce the temptation to de-risk exactly when people should be staying the course and not taking their money out of the market.
Yeah, I remember that we talked about that in one of the episodes with Don Esra, and it's about the mental accounting and the framing of it. So it's a really good approach, which I think people can easily understand. I was also wondering, when you're thinking about investing in a life cycle, you can also think about how is ESG, how should that play a role? And I think our previous guest, Mosh Milevsky, he had a question for you, but I didn't plan to repeat that one. So let's roll the tape and see what he has to say.
What I would like to know more about is the ESG debate that's taking place right now. Environmental, social, and governance. What are her thoughts on how this is changing her business, whether it's investment allocation, whether it's dealing with the political environment, to talk a little bit about how ESG affects the process of design in the DC world? That would be my question.
So my answer to that would be that it depends a lot on the sort of regulatory environment that you're in. So in the US, for example, retirement plans are governed by this body of law called ERISA. And under ERISA, fiduciaries have a duty of care to participants. And, they basically have to invest for the best outcomes of participants. And there's been a lot of, if you've been following it, a lot of not very helpful political back and forth on the extent to which ESG considerations may be taken into account in default investment options. And there's been a lot of flip-flopping. When the Democrats are in power, they want to make it easier to consider the ESG considerations. And then the Republicans issued something that you couldn't take ESG into account at all. And now we're somewhere in between. And so, that obviously is going to have a big impact. In Europe, on the other hand, you have regulations that require you to actively take into account ESG considerations. You don't necessarily have to invest on the basis of them, but you need to show that you have considered them while making the investment decision. So, this all has a sort of huge impact on how you take it into account, particularly for default investments. But, my opinion, for what it's worth at the end of the day, is, there are some factors in ESG that, clearly do have a financial impact. Nobody wants to be left with stranded fossil fuel assets. Nobody wants to be left with property investments that are underwater because of coastal flooding. And there is ample evidence to show that good corporate governance certainly reduces risk and tends to lead to better outcomes. So, these are all factors that active managers are already taking into consideration. And I'm sure they will just be sort of folded over time as we become more aware of what these factors are. They will just be folded into the basic investment decision-making process, and that way make them their way into investment allocations. Some of the other factors, some of the social factors where it's harder to show a measurable economic impact, I would expect those to be more sort of specialty strategies that you can offer on a plan menu, that if somebody specifically wants to invest in something with a social impact goal, they can. But I think that is less likely to be incorporated into default investment options.
Thank you, Catherine. And I was thinking now I'm going to jump a bit more to models and assumptions and thoughts around that. Assume that you and I today were to build a model for a trustee of a pension scheme. And what kind of estimation should we use for projected risk returns and correlations? For example, one could say common way is to just use the long-term historical averages from very long time periods. Another way is to, as Keith Ambas here argue for, is to try to identify the different longer-term economic regimes. So it could be for 10 to 20 years, you can have an economic regime and then you have a shift and the assets behave a bit differently. So when you're going to do this sort of long-term modeling, how do you sort of pick your expected return, your expected risk, and your correlations?
That's a super important question, because again, we're back to the garbage in, garbage out. If you have a model and you feed numbers into it, you're guaranteed to get a new set of numbers, but do they make sense or not? The inputs are critical. The The problem with using historical returns is that depending on the period that you happen to choose, it can give very distorted results. Like if you'd used historical returns at the end of the 1980s, your mean variance optimization would have told you to load up almost exclusively on Japanese stocks, which would have been the worst decision you could ever possibly have made. So I'm not a huge fan of using historical returns. I mean, in all the work I've done recently, we've always used long-term, forward-looking predicted returns. And here we're talking about sort of 20, 30-year returns, which basically you forecast on the basis of current valuations, dividend yields, expected long-term growth. And that gives you a sort of hopefully stable long-term perspective. And I mean, that does incorporate historical information to the extent that you're incorporating historical information on equity risk premiums and everything. But I mean, I think that is the best that we can do, is we make our best forecasts and then we adapt accordingly if they are not correct. And obviously identifying when the regime has changed, I mean, that is the most challenging thing of all. You try to do it, but it's very difficult to know at the time whether this genuinely is a regime change or whether it's just whether it's just volatility.
I want to go back to something else you talked about earlier, about modeling and trying to modeling something that is robust rather than optimal. And I think this goes back to say, should you satisfy, basically find a result that is okay, and then try to reduce the risk that you end up in trouble, or should you optimize, trying to find the best solution given the model you're working with? And I just wanted to know, how are you applying that in practice to sort of satisfy or take something that is robust?
I think satisficing is the sensible way to go, because when you're optimizing, you're making a very strong assumption that your inputs are correct. And if they're a little bit wrong and you try to be too clever, you could end up with something that produces totally different results to what you intended. I mean, I've done a lot of work over the last few years on designing solutions for the post-retirement phase, because I think that's a very important area in the DC space. And this started first when we had a client who wanted to create who wanted to sort of deliver stable income to his participants after retirement, but couldn't get his board to approve an annuity solution. So he asked us, what would you recommend? What sort of investment option and drawdown solution should I be offering? And we did a ton of modeling. We looked at sort of, what if we had a stable value fund, which is kind of a low risk insured bond fund? What if we replaced laddered bonds for the bond allocation in our target date fund? What if we added low volatility equities? And then we ran lots of simulations on how would these sort of our drawdown strategies perform in these different situations. And at the end of the day, what we came back to was the landing portfolio of the target date suite, which was like a sort of 40-60 portfolio, was the best and most robust solution. And then when I was at Smart, we engaged on a similar exercise where we tried all sorts of, and we tried all the fancy utility function stuff and everything. We tried to really sort of look at it from every angle. And we ended up with exactly the same result, that if we're not sort of, assuming we're not including any annuities, something around a 40-60, maybe even 50-50 equity bond split portfolio delivered the best results. So, I mean, and I think that's a sort of good, robust conclusion.
So you're basically saying, if we do model something, a good landing portfolio, in your opinion, based on what you have done, would be like a 50-50 mix in terms of stocks and bonds, painting with a roller rather than with a brush.
Something around that range, yeah. We ended up with something between sort of 40 to 50% equities, yes. Because I mean, I know it may sound higher than you would expect for the post-retirement phase, but the thing is that, like we already discussed a little bit earlier, you have to balance the two risks. You've got the risks of sort of immediate volatility, and then you've got the longer term risk of shortfall risk of running out of money. So if you're too conservative at the point of retirement, when most people will still have a 20 to 30 year retirement horizon, sure, you'll have peace of mind at the point of retirement because it doesn't look like your money is fluctuating all over the place, but you're much more likely to run out of money, which is also a very big risk.
I'm going to challenge you a bit there on your sort of 50-50 mix, because if you take a sort of calculation on the back of the envelope, you should take into all the money someone has. And just to make the calculation simple, assuming that someone in the UK have £125,000 and that they have a state pension, full state pension, which is £10,600 a year. If you would sort of go and buy an inflation-linked annuity to deliver the state pension, it would be quite expensive, and you probably have to pay £250,000 for it. So when you're then looking at the person's overall investment portfolio, they already have 2/3 in the safe, robust asset. So even if they stick 100% into equity, their overall portfolio allocation is still a 60-30 in terms of bond versus equity. So aren't we being too cautious when we design the life cycles, instead of looking at the overall picture, just looking at sort of workplace pension in isolation? What do you think?
So I think that in theory, you're absolutely right. But this is probably where the investment theory hits the behavioral theory. So if we think about this person who's dependent on their state pension, they already have a large share of guaranteed income in their portfolio. They may be likely to have a lower level of financial literacy if they do not have a very high level of income. So, and they may not have a lot of outside assets. So for them, this pension pot is the biggest pot of money that they have, and they're probably going to be very sensitive to fluctuations in it if it goes down 30% suddenly. So, and it also may be, I mean, if it's their only kind of safety net, I mean, we're making a lot of assumptions here, then they may need to pull on that for any emergency expenditures. So you wouldn't want to have massive fluctuations in the value of that fund. On the other hand, you don't want to put it all in cash either, because then they would be missing out on a lot of returns. So I think that our basic 50-50-ish portfolio probably is a fairly good, safe, do no harm variation. And then, of course, if they want to put it all in cash, they can. If they want to put it all into equities, they can. But I think from a behavioral perspective, it's probably not prudent to put it 100% into equities, even though from an investment perspective, you're absolutely right, it probably would make sense.
Yeah, I think it's the framing issue. If you see it in isolation, it's going to look scary, but you see it together, it's actually not that scary. And I think that's also where the communication and framing of pension comes in. And we tend to do compartmentalized framing most of the things. So I think you have a strong point there that the perception of people will be dominant, and therefore you need to manage that one too. You touch upon something I want to kind of continue with, and that is basically when you do a default strategy, so the one you just end up in, we typically don't really know about the member. We don't know how much other savings they have. We don't know when they plan to retire, because they don't really typically tell that. And there's very little information. So how do you put together a good portfolio when you don't really know what they're going to do? So what would be your sort of landing portfolio? Is it still the 50-50? You would say, well, if I do that, I'm half right, I'm half wrong the whole time, so I'm behaviorally safe, and it's a roughly stable thing, so why not settle with that? Would that be your argument?
I mean, I think you sort of touched on this a bit in your sort of previous comment, talking about how we're only looking at part of someone's sort of picture. And I mean, I think that's one of the big challenges of DC, is that because, people, as they change employers, they are likely to accumulate pension pots with different employers, but we are only looking at a sliver of their sort of situation. So we don't know whether this £20,000 that they have with us, we don't know whether this is their sort of full retirement savings, or whether they actually have sort of 2 million. Well, you probably wouldn't have 2 million due to your sort of tax restrictions, but, a significant amount of money with previous employers or something. So we know that we're dealing with limited information, and we don't really have much opportunity to get more information unless these people sort of actively tell us. So I think the only reasonable assumption, I mean, we are saving for retirement. The most reasonable assumption seems to me that everybody is going to be targeting a retirement income. So, this is money that is reserved for retirement, and typically people will want to take out money during retirement to pay for their retirement expenditures. So I think we should operate with our defaults on the assumption that this is a sort of investment strategy that is designed so that people will be able to use this as a source of income in retirement on a periodic basis. And if people want to use it in some way that is totally different, if they want to take out a lump sum in cash at age 55, buy a yacht and sail the world, or if they don't want to use it for their own spending at all and just sort of put it all into equities and save it for their heirs, I think, again, we get back to the behavioral part of things. We need to make it very easy for them to understand that if they want to do this, then they probably need an different investment strategy, and make it easy for them to communicate that to us. And then it's easy to put that money into a different strategy. But I think the default needs to be built on the assumption that it is as a source of income for retirement.
Very good. And that also, if you say a 50-50 is a no regret strategy, you are probably going to work whatever way. And if you really want something, you go and choose for that one. I was thinking, following up what you said about Don Esra, because if you would follow that thinking, you would say for the first 3 years, for example, you put in a safe and the rest in equities, you're actually going to have quite an aggressive equity portfolio if you do plan to save for 20 years, which I think, like, if you're then going to de-risk into something, if that's your sort of retirement solution, you probably should have a bit more aggressive investment strategy.
Yeah, I mean, we did a lot of modeling around this type of solution. And I mean, basically what it does is you would be, as you know, if you're always having a rolling 3 years in cash, you'd be steadily taking money out of the equity portfolio over time to make sure that your sort of cash portfolio is always topped up. So it does actually lead you to a kind of glide path where once you're right at the end of your life, you basically have just the cash portfolio and you've depleted the equity side of things. So it does create a glide path through retirement, but just a very gradual one.
If you go into sort of problem solving, you could do a payout product where you say every year of pension payment is basically a target date fund, and you stack them up, and then you basically have your solution, right?
Yeah. I mean, it's all just slicing and dicing the sort of, you don't necessarily even end up with a different investment solution. It's more about how do you sort of communicate it to the participant. I mean, you could just as well, the thing is with a target date fund, because it's one fund, and you can, and you know, if you have your 50-50 portfolio, let's say your landing portfolio, you design an algorithm that gives you a projected what is a prudent drawdown rate this year based on your life expectancy and based on the value of your portfolio. And you would want to probably update that on an annual basis. But then you would be sort of pulling out of the sort of whole portfolio. So the participant would always be seeing the sort of full value of the balance fluctuating. Or alternatively, you could do pretty much the same thing, but you just show it as the same buckets, and they see that the payment is always coming out of the cash bucket. Yeah. And possibly that's just easier for them to see because they can see, oh, I've got my payments for the next 3 years in my cash bucket. I don't need to worry about what's happening in the rest of it. Even if in practice, what's happening to your overall portfolio is not very different. So
that's a very good point. And I think that's also what Don Esra said. You can make a very advanced strategy, or you can have a mental framing, which makes it easy to understand, and you're probably going to end up pretty close. But the point there is, like, the one that people feel they understand is probably the stronger solution, because what you understand, you tend to trust. If it's too much of a black box, it can be a bit scary.
Yeah, exactly. I think a lot of this is sort of like the post-retirement phase. I think it's much less about investment modeling. I think we have all the sort of investment components that we need to develop good solutions, and more about how we communicate it to people in a way that they feel comfortable with and where it meets the needs that they have, rather than the needs that some investment provider may think that they have or should have.
And also to go back to what you said earlier about the uncertainty in the markets and how difficult it is to model something. If you get assumptions slightly wrong, you're going to have a massive impact. So we probably shouldn't put too much trust in our models, but put quite a lot of common sense into it as well. And then all of a sudden, it probably is easier to explain it to members as well.
Yes. Yeah. I mean, you also do teaching. We were just before this talking about how you sort of we're lecturing at the University of Maastricht, and the old adage is if you can't explain it to someone else, then maybe you don't fully understand it yourself either. So
I think that's a very good comment. With that, I would like to open up for questions from the audience, and I forgot to say that in the beginning, but the important part with Pioneering Pension is that you who are in the audience, you can ask your questions to the speaker, and it's very rarely we have someone in the room who's actually building life cycle strategies and thinking about retirement products on a practical level. And I think a lot of you out there in this call is doing that. So please shoot your questions and we will deal with them. The first question here comes from Henry. And it is going back to the earlier discussion saying, can you explain what the utility function does?
Well, the idea of the utility function is I suppose it's about maximizing utility. So you're trying to, when you're spending and drawing down, you are trying to generate the maximum utility to the individual. And there are trade-offs involved there. So the utility function, for example, it includes input. I mean, obviously, you've got saving versus consumption. Everyone would like to consume more. But on the other hand, if they don't save enough now, then they will have lower consumption in the future. Then you have to include interest rates, and then the risk aversion parameter is very important here because it tells you how much risk are you comfortable with taking in order to sort of, obviously taking more risk typically increases future consumption, but it can also reduce short-term comfort because you have to deal with fluctuations in your portfolio. And obviously there is also a risk that the risk taking doesn't pay off. So the utility function tries to generate the maximum utility to the individual. And hopefully that way we would be able to sort of use that to create a life cycle glide path. Like I said, in practice, sort of you have to assume the value of so many parameters for which there is really no observable information. That I think it's a lovely theory, but in practice, I find it very unreliable to use.
Thank you, Catherine. That was a good and straight answer. Henry had a follow-up question as well. He was basically referring to Nest, where you have this period where they de-risk early on. Isn't there a big risk that they had a low risk, 10 years on, they realized, oh, market went really well and I kind of lost out, missed the opportunity that the rest of the people in the fund had. Do you think that is sort of a risk as well?
I mean, it is. I don't know how much it works in practice because I know that the participant base at Nest, generally speaking, is very disengaged. On the other hand, I suppose you could use that disengagement argument to say, if they're not looking at their balance anyway, then just put in the risk at the start of the savings period. One challenge that I do see with this sort of having high equity risk earlier and then starting to de-risk, I mean, yes, it's the right thing to do. The thing is that usually the contributions at the start of your career are very small. So, and this is one of the reasons why I think that most glide paths, at least here in the US, they start to de-risk too early. Because the thing is that you've got your, even if you do have a situation where you have the highest equity risk at the beginning, let's say you have 100% equity risk at the beginning, but that's when you only have a very small sort of contribution base. So by the time you actually have accumulated a significant amount of assets, you're already sort of de-risked into a much more conservative portfolio. So probably missing out on optimal equity risk on the first 10 years on your contributions. It might not be the worst thing in the world because you only had a fairly small balance to get those contributions on. But from an investment point of view, yes, I think you should be maxed out on the equities. And I don't know what the sort of feedback has been then on, has this sort of low risk approach, has it been successful in persuading to people? Has it had a significant impact on whether people have stayed better in the funds compared to other providers that have had a traditional sort of full allocation to equities in the beginning? That would be something that would need a bit of research done on it.
I think Nest is probably looking into it, and I think what they're going to find is, since no one looked at it, it's not going to have a big impact.
Yeah, that wouldn't surprise me.
Paul has a question for you, and this is, I think, it's quite an interesting one. No one has ever invested in a global economic environment that is a race to net zero. What use is mean variance analysis, stochastics modeling, and Monte Carlo simulations, since the assumptions are based on past experience in creating an appropriate future lifestyling investment strategy? So there's a good part. If you say we're going with a new type of economy now, is a race to net zero, this means that what we learned in the past is not that relevant going forward. How are we gonna how do we avoid putting too much trust and belief in the models?
Well, first of all, I would argue that we're not in an environment that is a race to net zero. In fact, I'm extremely encouraged that we are finally actually getting good nominal, not necessarily real, but at least we have decent nominal yields on bonds, which I think is a significant improvement in actually having a real risk-free rate, which has been a big problem earlier. So hopefully the equity returns are not a race to zero, but...
Well, I think you meant like, carbon net zero emission, that you basically, the name of the game is changing. How relevant is the old modeling?
Well, I mean, this goes back to our previous conversation about should you use historical returns or projected future returns. So yes, historical returns always, they tell you exactly what happened in the past, and they contain little, if any, information about what's going to happen in the future. So this is where you have to rely on projected future returns for, what do you think the returns are going to be, variances, correlations, and it's your best guesstimate, if you like, based on what you know about current valuations, what you expect to happen in the economy going forwards, and then that is the basis for the model. And I mean, yes, if you have a regime change, it's going to increase the level of uncertainty of your models because it's going to be more difficult for you to guess things like correlations. I mean, are we now back in a regime where the stock bond correlation is going to be positive rather than being negative like it has for the last sort of 30 or 40 years? But if it's the same as any regime change, you always have to have forward-looking assumptions and update them as you go along.
You don't know what the future will bring, so it's probably good to say, what if my assumptions are wrong? What happened then? What if I'm assuming I'm going to have a higher return than that is going to be? So you can stress test also your assumption when you do the modeling. So the only thing we know that predictions about the future when it comes to expected return, the only thing we know for sure is going to be wrong. So you have to look at many of them and see, are my outcomes still sufficient? If my assumptions are wrong, if it's okay, well, then you do have a sort of a good approach. If you cannot take it, well, then you probably should rethink your approach.
Yeah, and this comes back to the not trying to be too clever with your models and sort of, because in a crisis situation, all the correlations go to one and nothing behaves the way you wanted it to do. So rather than having these very sort of highly levered strategies or something, you want something that is robust, that will work in most of the foreseeable scenarios. So.
Yes. And we have a question here from Kim. She asks, what are your thoughts about hybrid target date strategies, which combine multi-asset target date portfolios with guaranteed income through some type of annuity?
So, I mean, I've worked on these products before, and I think they're a good idea in the sense that sort of this is very much aligned with the idea of we're assuming that people are going to be using their retirement savings to provide income in retirement. Annuitizing part of your balance does give you better expected returns than a pure drawdown strategy, because you get a higher sort of expected payout rate from an annuity than you do from drawdown usually. The challenge with those things is in the implementation. I mean, it's easy enough to design the investment part of things, but you're doing a lot of sort of putting parts together. And certainly in the US, there are not many of these live. Implementing them is quite difficult. And one thing that I've been thinking about a lot recently too is that, in order to make implementation of these easier, providers have very understandably and sensibly tried to standardize them as much as possible. So, for example, it's assuming an age 65 retirement when the annuitization happens so that they can get economies of scale and institutional pricing. But I also worry that by standardizing them, we may not be aligning with the way that people actually want to use these products, because all our behavioral research shows us that retirement is increasingly becoming a kind of transition period rather than an on-off. You know, people may retire from their main job, but that doesn't mean that they want to actually start living off their retirement savings. Maybe they're sort of downshifting, or, you know, they do another lower pressure job before fully retiring. So I think the automated element of these, it remains to be seen how attractive they are to participants and how well they sort of align with the way that people actually want to use these things. I think if we could offer more flexibility around when the annuity is taken, that might be helpful.
And if you automatically put someone in an annuity and they didn't really want it and come back and say, I didn't want that, well, you're kind of stuck in it. So that's also going to be a bit difficult from sort of the consumer's perspective, right?
Yeah, I mean, I think in the US, in practice, it's virtually impossible to automatically put someone into an annuity. You can make the annuity sort of automatically available, and you can make it very, you know, but they will have to tick some sort of a box to say, yes, I understand that I'm buying an annuity and this is what I want to do. Automatically putting someone into an annuity, I agree with you. I think that's sort of very problematic, because what if they were just disengaged and didn't want to lock up their savings in an annuity? Then yeah, that is obviously a problem.
So we have a question here from Larry. He says, what is your opinion on guaranteed lifetime income options in retirement versus drawdown strategies? Do you have a favorite or preference?
So guaranteed lifetime income options, I'm not sure whether he's thinking about these guaranteed lifetime income benefits that you have in the US, which is basically where you have a sort of investment portfolio, and then you have an insurance wrapper on top of it, which guarantees you a certain level of income from that portfolio, regardless of what happens to the market. And then if the market happens to experience a downturn and you deplete your savings, you're still guaranteed that savings amount later. So I've always liked sort of clean strategies. So rather this kind of combination of investment and an insurance around the investment, my own preference would be I would rather use part of my money to buy a pure income annuity and then keep the rest of the money invested. And that way I'd get the sort of the guarantee and the investment, and I'd have more control over it, and I would probably also be paying lower costs on it. I think that I think drawdown is good. It's not the most efficient because you're missing out on the benefits of longevity pooling. And I think one of the biggest problems that DC participants face is that DC is very inefficient because you miss out on longevity pooling for the post-retirement phase. And that's one of the main reasons that DB gives such higher income than DC is the longevity pooling. I mean, that can increase your income it can be sort of 30% increase to your income if you do proper longevity pooling. And I think that's a free lunch, or should we say free dinner, as we were joking earlier, sort of, that, you know, DC participants are missing out on. So I would prefer some way to sort of introduce longevity pooling, at least partially, for the post-retirement phase.
Going back, I remember the previous chat we had with Mish Molevsky, and he kind of developed a solution to kind of compartmentalize it the way you suggested. So he said, you have 20 years of a fixed drawdown, you put some money into that, and the rest you put basically in Tontine. And if you happen to be alive after 20 years, you get a cash payment, which you can use, you know, to buy an annuity, or you can do something else. But that's also a way to sort of, in DC, a simpler way to kind of offer risk pooling without sort of, in a relatively straightforward and simple way.
Yes. And there are lots of, you know, you could also offer you could also invest part of your money in the Tontine-like solution right from the start. It doesn't necessarily have to be the late life payout.
Yeah.
But I mean, I'm a massive fan of tontines and longevity pooling, but, you know, there are legal hurdles, and I think it's also a behavioral hurdle explaining to people how these things work. And actually one point, I mean, relative to this relates to the previous question too, is that if you can ensure that late life, the tail risk of having a very long life, and then you actually reduce the sort of, let's say you have an annuity or a tontine or whatever that gives you starts to pay out at age 80, then you've actually reduced the retirement problem to a fairly easily solvable, maybe you've got a 15-year time horizon for your drawdown fund, and that's actually fairly easy to solve for. So again, this is all about making the problem more manageable and sharing the risk that it's worth sharing.
Yeah, thank you, Catherine. I think that's a really important thought around kind of, can you simplify the problem and make it solvable without making it overly complicated? And I think as an industry, we have a tendency, we like complicated stuff, so we make them unnecessarily complicated. But therefore, our challenge is to uncomplicate stuff. Christopher has a question here. Did you study the added value to utility of having a path-dependent asset allocation and guided withdrawals in drawdown?
So guided withdrawals in drawdown is exactly what we were doing. The idea was that we were building a sort of solution that sort of gave you a recommended drawdown rate. The goal was to sort of provide you with a steady income in retirement, but also to adjust that if for some reason the market environment was too negative. We did not study the impact on utility of that, because we were just getting the results we were getting from trying to use utility were just so unreliable that didn't feel like the most useful way to do it. And
what did you use instead as sort of the metric to evaluate against?
Usually shortfall risk.
And how did you define that, the shortfall risk?
Basically defined as the probability of running out of money before your expected life expectancy. And I think we were using life expectancy of 96 here. So what is the probability that you will still have money left? You will have enough money to get you through to age 96. And then we looked at different, what is the shortfall rate that you are prepared to accept? Are you prepared to accept a 5%, 10%, 15% shortfall rate? And then how does that guide the drawdown decisions that you make?
But then you're basically self-insuring longevity risk, and that must require quite a big pool of savings in order to do that.
Well, yes. But I mean, that's what DC is. If you don't do longevity pooling and insure against the tail risk of being the person who lives to be 103, basically everybody has to invest individually as if they're going to be the person who lives to be 96, even though only about 4% of people actually will live to be 96. Or then you have to accept a higher shortfall risk and the possibility that you will run out of money before you die. Yeah. I mean, that is the problem that we face with DC. Everyone is having to do this by themselves. I mean, the DB system, the funding basis for DB systems was not good, but the longevity pooling and the guaranteed nature of income after retirement, I think, is something that I certainly hope we can reintroduce into the DC system, but in a way that is sustainably funded.
I would like to comment on that a little bit, and that is like, well, you're never running out of money because you do have your state pension at the end. That's sort of the rock solid bottom, but you're running out of the extra money that could be nice to have a little bit of better life around it. We have a question from Rita, which says, which would be, in your point of view, the most important advantage of life cycles over target date funds? That's a good question.
I mean, basically, they're the same thing. It's just that they're investment strategies where the risk level adjusts over time, reflecting the fact that a participant's risk tolerance changes at different points of their life cycle. I mean, the target date fund, you've just got basically a life cycle strategy bundled into one fund. So it's a fund of fund structure. Whereas in the life cycle, you can see the individual underlying funds. So I suppose if there is value in the participant being able to see what the underlying funds are, then that could be an advantage of the life cycle approach. Maybe it's sort of, we were talking earlier about this sort of splitting the money up into the sort of short-term spending portfolio and the long-term growth portfolio. Maybe it's easier to sort of evolve a life cycle strategy to that approach than a target date fund. On the other hand, the target date fund has the virtue of simplicity in that you have just one fund. It's called the 2040 fund or whatever, and it's very simple for the participant to understand that this is the one investment option that I need for my retirement. So, it's pros and cons, but I would say not, from an investment point of view, there shouldn't be much difference.
It's a bit tomato
Exactly.
different. And I would say what I see as an advantage with a life cycle is that if you want to change the flavor, it's much easier to do that, because if you, for example, will have a ESG flavor and you want to have not an ESG flavor, or also the world market flavor, you need two lines of target date funds in order to achieve that, while within life cycles you can achieve it with different weightings on the allocations.
That is a fair comment. Yes, that's true.
We have a question here from Christopher as well. The good thing about gated lifetime income insurance, I think is that the client remains ownership and legacy benefit, so it appeals to the wealthier segment.
Is that guaranteed lifetime income insurance?
It must be guaranteed, yeah.
But what does that mean? Because the thing is that if you buy an annuity, you specifically lose the legacy benefit. Or is there some kind of insurance where you can insure the annuity so that if you...
No, I think it goes back to, I think it was his previous question, that if you have this investment strategy with a guarantee at the bottom, the advantage with that is it's still your DC money, but with an insurance guarantee on top of it. So if you die, the money comes back to you.
So yes, the GLWBs, yes. Yes, that's true. Yes, it's true. It gives you flexibility, but it's sort of, the GLWBs are usually fairly expensive. You're paying a sort of, I think the wrap fee is often about 100 basis points on top of the cost of the investment funds. And then you have to evaluate how good the guaranteed income that they are paying out is compared to what you could get by, for example, structuring a sort of, using part of your money to buy an income annuity and keeping the rest of the money directly in the investment products, in which case, again, you would still retain ownership of the part of the money that wasn't used for the annuity. So, it's all about trade-offs, isn't it? And of course, if you're sort of, if you're wealthy enough to not need to worry about running out of money, then you probably don't need any kind of guarantee. Then you can do the drawdown strategy and have the best of both worlds. You have the full flexibility, you retain ownership of the money, and then it's all sort of, you can leave it as legacy to your heirs. So,
and I think the important part you mentioned is like cost and charges can have a massive impact on the outcomes you're going to get, and particularly if you in retirement as well, it can be quite expensive to do your sort of retirement planning. So it's really important to check that out. Mm-hmm. Catherine, I think our time is running out, but before we're going to end this webinar, I would like you to get a chance to ask a question to the next speaker. And that is Jerry Moriarty, and he is CEO of the Irish Pension Fund Association. And we are going to talk about introducing auto-enrollment on Ireland. And that takes place on June the 27th. What is the question you want to ask Jerry?
So my question for Jared, and by the way, hi Jared, I think we met once when we were at State Street in Boston. So in Ireland, you're in the enviable position of designing a new pension system. Obviously you have some legacy system, but you're doing sort of, you're starting from scratch here. And you have a lot of examples to look at. And I think one area where all the current DC systems fail is in integrating the post-retirement phase. This is a lot of what we've been talking about today. You've got the sort of saving, they're all designed to save up to retirement, and then there's this big discontinuity, and none of them currently really carry people well into retirement. So my question for you would be, what can you in Ireland do to learn from the mistakes of the US, the UK, Australia, and build something that will also carry people seamlessly into retirement and provide them with good quality income during the post-retirement period?
Thank you, Catherine. And I would like to thank everybody in the audience for coming. It's a pleasure you've been here, and thank you for all your questions. And I'm looking forward to see you the next time in Pioneering Pensions in June the 27th. And Catherine, I would like to give a very special thank you for coming here and sharing your knowledge and your insights. I enjoyed it a lot, and I think a lot of people who listen to this are going to think, yes, there was a lot of good thoughts in there we should take into account when we're trying to model and build our life cycles. So once again, Catherine, thank you for coming.